Hello. Hello. Good afternoon, everyone. Can we ask everyone to move towards the center? There are still a lot of available seats in the center of the room. So the other room is already.
3 more minutes, and we start at 1:45 mark. I see people still coming back. Okay. We'll need to also to compress. Halper is.
I will.
Here.
The presentation will be 2 minutes, Marvin. I will keep
Yeah.
it super short. Don't worry.
Yeah.
Mine is around 5 minutes. I'll try to go.
Yes. I mean, just to accommodate to. Can we close the doors, please, Brian? Thank you. Colleagues, 1:45 now. As we said, we're going to start. I'm really happy that we're having this session on private sector evaluation. This is very close to my heart, and it was one of the things that I said a number of times. Veronique and myself, we said that we had to incorporate private sector evaluation more actively into AW, right? And it's happening now. There was this session early on, and since a couple of years we started bringing more subjects, more topics related to private sector evaluation. And today we have one very special topic on private sector evaluation. Private sector evaluation is has its own characteristics that sometimes those evaluating sovereign operations are unable to capture, right? Private sector evaluation is about assessing operations in which public sector money has been put to finance private sector operations. Public sector money to finance private sector operations. And so the test in evaluation follow different criteria as opposed to the traditional evaluation that we do. The majority of our organizations, I was a evaluator of a IFC, MIGA, all private sector operations of the World Bank Group for a number of years. The structure of our evaluation system for private sector evaluation was different from, as I said, sovereign operation. For once, you got to explain the rationale for using public sector money to finance private sector operations. What are the market failures? You don't have that test in sovereign interventions. You got to also explain the additionality. What is the extra value that you are bringing to the table that the market, private sector market, is not satisfying? You got to also to test the profitability of the operation. It's at the heart of the evaluation system. How profitable is? Why is this important? Because you cannot intervene in the private sector market by subsidizing operations and crowding out other private sector actors. You would be acting in contradiction to your mission of developing markets, and right. So there are a number of requirements to satisfy, to declare an operation successful in private sector, and of course you still have to test the results. I mean the development results. What changed? Greater competitiveness in the market, more employment, innovation, etc. You still have to test this in evaluating private sector operations. That's precisely the framework that we're going to be referring to. That's why I'm explaining these components for those of you who are not familiar with this, or reminding everyone, for those who are familiar with this framework. That's how we assess private sector operations. That's the framework that we will be referring to look at the issues that we will be discussing this afternoon. Today, the subject is a very interesting one. It's about intervening in the private sector through investments in equity and quasi-equity. This is a very specialized field. Again, you can intervene in the private sector using loans, regular loans, or you can intervene through equity, being part of the company itself. And today, that's what we're talking about. And when you use equity, you can also intervene putting money directly, direct investment, we'll refer to that. Or you can use your money, these multilaterals or bilaterals or governments, you can use the money to put it into funds that would reinvest these resources so that you can reach out to more actors in the private sector space. So those are the two modalities that you use, basically, the two modalities that you use when using equity. And this context will help us to examine the results that will be presented today. We'll hear about the results, the process, of investing equity in three major multilaterals in EIB, European Investment Bank, is a major investor using equity. In the European Bank for Reconstruction and Development, EBRD, that uses other criteria of transitions, but still development, invest in equity. And we'll hear from ADB that also uses equity in the two forms. From EIB, we'll hear, from EBRD, we'll hear about a special type of investment, is investment in venture capital. That's a special type of investment using equity to promote innovation and growth of new companies. So we have a great cast of presenters today to explain to us the results of this institution in using this specific instrument of private sector investment. For this purpose, we have Albert Dinster, Principal Evaluation Manager of EBRD. He will be talking about investment, as I said, in venture capital. We'll have Aaron Gerben, evaluation expert of EIB, and Gloria Paniagua, senior evaluation specialist of the Independent Evaluation Department, the IED, of Asian Development Bank. So we have a great set of experts here to tell us a little bit about their experience, the institutional experience in investing in private sector by using equity. We're going to start with Aaron first, who will give us a broader perspective. As I said, this is a large investor. And we will explore later. The plan is this. We're going to have 3 quick presentations to set the stage. We'll ask some questions, and then we'll open up the floor to talk with you. We plan to talk about the process. We plan to talk about the rationale, I just said, right? That's why I explained this, the rationale of using this instrument, the process, the results themselves. And then we're going to talk about, for those who are interested in understanding better how to evaluate this type of instrument, we'll dedicate the last part of the session to talk about methods for evaluating funds or evaluating direct investment. That's the plan. Let's see if we achieve our objective in the more limited time that we have now. In the middle of this, we'll open up the floor for you to share your questions or comments with the presenters. So, Aaron, the floor is yours.
Thank you very much, Marvin. I try to be very, very short. So this is an evaluation that we finished last year, and the topic of the evaluation is the EIB Group's equity and quasi-equity support to small and medium-sized enterprises. So Marvin mentioned already the rationale as a question. So just to talk a little bit about why should European taxpayers' money be invested into to venture capital, to equity, to all kind of things. The rationale is coming from productivity and innovation. There was a recent paper by Klenow and Lee. The title was Innovative Growth Accounting. And in this paper, they show on US data that about half of productivity growth in the US is coming from firms that are less than 5 years old. So for economic growth in general, these firms are very important. On the other hand, such firms quite often don't get sufficient financing from the traditional banking system because they're just too risky, and banks just are not able to handle that kind of risk. Also, so there are specialized financing types that are developed for these kind of firms. depending on the maturity of the firms. On the left-hand side, you can see different types of financing options for these firms from the very young age until maturity. These include business angels, venture capital, growth capital, venture debt, and so on. But these kind of financing options are also limited. There is a good reason to think that the private supply of these funds is not sufficient because of information asymmetries, and also because the innovation is a public good, and the positive externalities coming from innovation are not factored in the investment decisions of the private agents. So this is the general rationale. In Europe, what is also adds up is that Europe is lagging behind compared to other areas of the world when it comes to especially early stage and middle stage risk capital. So only 9% of global venture capital assets are invested in Europe. So our evaluation was focused on the EIB activity on these markets. We are focusing on two portfolios. The one is an indirect portfolio where our subsidiary, the European Investment Fund, is investing into a wide range of private funds and co-investing with these private investors into to the final beneficiary companies. And the other portfolio is a specific portfolio where we do direct investments. So the EIB loan officers are picking the firms that they are investing into, but it's in a very specific market, the venture debt market, also called quasi-equity. I won't go into detail what this means, but it's kind of like a debt product that has some equity characteristics, and it's suitable for firms who are who has already developed somewhat from the startup stage, and they want to achieve further growth. On the right-hand side, you can see the volumes of a different type of stages that the EIB is investing into, and as you can see, the bank and the fund are present at all stages, from really early stage venture capital to later stage private equity that's relevant for mature firms. Jumping to the lessons from the evaluation, first I would like to start with the lessons on the indirect equity support. The first main lesson is that the EIF operations, our indirect equity support, helped to develop the European venture capital and private equity market through implementing best practices, improving governance, to strengthen fund management teams, and also with the intention, and it was measured as a result as well, it helped to provide opportunities to new fund management teams to enter into the market. A second important lesson is that while the majority in absolute terms, the majority of our investment went to the more developed countries within Europe, in relative terms, compared to the overall venture capital and private equity market, the EIF overweighted those member states that have less developed markets. So we contributed to the cohesion within Europe in this respect, overweighting the less developed markets and helping them to grow. Another important lesson is that when we look at the contribution of public support at the different stages, what we find that the later stage investments are much less useful in terms of policy contribution than early stage investment. Whereas at the early stage we can show high relevance, high additionality, high impact, this is not the case at the later stage. On the other hand, when we look at the financial results, it's just the opposite. The later stage investments into private equity, to buyout funds, are performing much better in terms of returns and also in terms of return volatility. So they help to stabilize the overall portfolio. But what we highlighted in the evaluation, that the policymakers have to make a choice within this trade-off between profitability and policy impact. And finally, another important result is that when we look at the final impact of these operations and compare to fully private equity investors, what we see is that the firms supported by the EIF funding, they grow and innovate as well as fully private investees. So public money is invested at least as well as impactful as private one. Finally, a few lessons about our direct support, venture debt. There, what we show is that what the EIB is doing is serving a clear market niche, and we can show a very high additionality at the level of investors. Sorry, jumping back. On the other hand, given that these companies are very different from the traditional business of the EIB, which is infrastructure companies, sovereigns, and so on, the institution and the institutional bureaucracy administration has a lot of difficulties to handle these fast-growing firms that carry a lot of uncertainty in their business. So, and this creates a lot of frictions and also a lot of inefficiencies in the business. So one of our recommendations was to resolve this kind of institutional cultural problem that makes a clash between the rock stars and the symphonic orchestra that we have the venture debt investees and the traditional sovereign investees of the bank. So I think now I pass the floor to.
Thank you very much, Alper.
Okay, thank you. Brian, thank you, and Marvin, thank you very much for providing the overall like the definitions of the concepts that we are using. And I will first start maybe making a little addition to that. I mean, what is venture capital, and then how it basically, to what exactly we are referring to here. It is in this direct equity investment space. Essentially, EBRD's venture capital investment program focused on companies that were like relatively small. When I say small, typically 25 to 30 employees. The companies, they have completed the product development stage and trying to initiate commercialization of that product. So that essentially that means they have the product itself, but they are not really marketing it. So that they want that product to be in the market, and then they wanted to increase their revenues as fast as possible, but that is not happening yet. They have revenues, as I said, but they are loss-making. So that was the profile that the bank invested in under this program, and then we invested per company up to 10 million euros. Initially, this is kickstarted in 2011, and the initial commitment was 100 million euros. I am sorry, this one. But then we deployed only 68 million. We have invested in 15 companies. And at this point, right now, we managed to complete 6 exits. Exits means either we managed to sell the companies in a profitable way or transfer them. 4 of them are write-offs, 4 of them are bankrupt. Essentially, they don't have any value anymore for us. And now 4 are still in portfolio. So it is, while this has happened, the bank observed all these operations and all those like investments that we have made through this program, and then noticed. And this was important because Marvin also mentioned about why public money is here. For us, that was also relevant for EBRD's strategy to have this program, because we wanted to support knowledge economies. After the financial crisis in 2007 and 2008, EBRD was expecting economies to pick up in the regions that they operate, but that did not happen. So EBRD felt that it needs to be proactive and do something to revitalize those economies. And then that is rebranded as this Knowledge Economy Initiative at the EBRD. And the Venture Capital Investment Program was the main, let's say, flagship instrument of that program. So if I go back, so then this has further developed into this digital transition program of EBRD, which is another strategic tool. Then the program further expanded in 2018, 2021, and 2022 with additional envelopes. So right now, it is indeed more than, I think, $500 million that we are deploying with this instrument in EBRD. So it is, what did we exactly achieve? So, I mean, were we really additional? This is also another like element that Marvin mentioned. And then looking at this investments, what we see is that yes, definitely we were financially additional. We are operated in markets where the capital wasn't available at all at that time. But we also see that also non-financial elements were also very important. So environmental and social performance requirements, for instance, but also others. In those investments, EBRD had representation at the board of these small companies. And now we managed to improve in many of these companies' corporate governance. So for instance, give you one anecdote. It is like simply having minutes of board meetings. So in those companies, at the time we invested, that wasn't, for many of them, this wasn't happening. So we are basically, our own investment officers, they taught these companies to have proper board minutes, for instance. And then in terms of regions, initially this has started with Russia, but after 2014, after the invasion of Crimea, EBRD stopped investing in Russia. And this was a very large market, but EBRD managed to move all those like investment opportunities to other regions that we operate. And also it is, we also see this diversification as good performance from EBRD, for EBRD's program. At this point in time, though, still, most of the investments are in Poland and Turkey, which are relatively developed markets. So that context and the maturity of the market definitely has an important influence on how much we can deploy. And the other thing is about like deployment of funds within the institution. One important finding that we have is that for about like almost like a period of 3 years, the institution wasn't ready to deploy this product. This is why investments really wasn't picking up initially. And then the whole team, new processes were put in place. The team essentially isolated itself from the rest of the bank. It is like the team itself causes like it protected itself from the bank and then bank's operations. And then they managed to start to make investments much faster. Initially, the investment period was up to 6 months. In time, they managed to reduce it 6 weeks. It is typically, on average, this happens in 8 weeks. So the thing here is that it is this isolation that is created with this program. Indeed, it inhibited essentially learning from this program. So essentially, this has influence on the EBRD strategy in general, as I mentioned about knowledge economy and this digital transition. But the communication with the team and the bank, it was indeed not that good. And then it is, as part of this evaluation, we recommended that to be improved, for instance. The other bit here is that it's much more challenging. The compensation and then the working conditions at EBRD for the venture capital professionals are not comparable to what is available right now in London. So this is why it is very, very challenging to retain capable staff with venture capital sector experience within the bank. This is why we see that it's like a lot of turnover, especially at senior levels, which we believe that puts EBRD's investments under a significant risk. And we also suggested this to be improved. So that is overall, all from my side. Overall, we found that yes, the rationale is still there. EBRD, yes, we are a public institution, but there is still a lot for us to do in the VC ecosystems that we operate. The program, this program generated an internal rate of return, gross internal rate of return of 27%. This is like exceptional in EBRD standards. But when we look at the similar venture capital funds established in the same vintages, in the same years, that is on par with market practice. So it is, what we are seeing is that although this was a first time internal VC fund, they managed to perform as good as a private sector VC fund. But on the other hand, we see very limited impact on innovation. This is essentially, this mainly comes from, this is a result of investment strategy. Because as I said, we did not focus on projects, clients, during the product development stage. And that's the stage where actually innovation is happening. So this is, again, if we are keeping this investment strategy, if we want to focus on clients who already completed product development for innovation, we have to do something else to demonstrate that we are impacting innovation. And then finally, yes, we we thought that it is like the synergies within the bank needs to be strengthened within this program. That's all. Thank you very much.
Thank you very much, Alper. And now, Gloria, for ADB.
Hello, good afternoon, everyone. Sorry, I'm a bit short, so you can't see the screen. Okay, IED conducted an evaluation of ADB's private sector equity investments in 2019. And actually, Marvin was a director general at that time, and he spearheaded this evaluation. At that point, I was actually with the private sector operations department, and I was more on the responding side of this evaluation. But now I have my IED hat and presenting the findings of this report. So the evaluation assessed the extent to which ADB equity operations added value were financially sustainable and contributed to development effectiveness in Asian development member countries during the period they looked at was 2006 to 2017. There were, how do you use this? Oops. Sorry. Okay, so the evaluation had 5 key messages. First of all, that private equity was an increasingly important source of capital in Asia, and that ADB could play a big role in key market niches. Secondly, the evaluation found that financial returns for direct equity investments significantly outperformed private equity funds. And during that time, it was seen that most of the direct equity were shifting towards doing investment at the IPO, the initial public offering stage, and that private equity funds were more targeting more established large funds. The third main message that came out from the evaluation was that, and I'll show you, the development, performance, and results of direct equity funds fare much better than private equity funds. And this is actually very consistent with what has been seen in IFC as well. Overall, about half of the equity investments succeeded developmentally. A fourth key message was what we call organization for delivery in terms of staffing, processes, et cetera. It was found that the organization for delivery hindered its ability to source, add value, and to some extent exit equity investments. And lastly, at that time, it was found that ADB lacked an overall business plan for private equity investments. Now, in terms of when we talk, in terms of why equity investments in Asia, so ADB and the rationale. So ADB makes equity investments for 3 main reasons. One, to help help capital constrained invested companies, providing funds. Secondly, to support improvements in the performance of these companies, private businesses. And thirdly, to help catalyze public and private co-investments. And at the time of the evaluation, it was found that private equity had become an increasingly important source of capital in Asia, and it had begun since the year 2000. When it came to the market areas, for ADB, 52% of direct equity was focused primarily in China and in India. Private equity funds were morely regional funds targeting also, some did focus on India. Now, during the evaluation period, ADB had committed $1.8 billion in resources in 67 private sector equity investments, and these were very much equally divided between direct equity investments and private equity funds. At the time of the evaluation, at the end of 2017, equity investment made up only 1% of overall ADB total outstanding portfolio, that is sovereign and non-sovereign operations, but it did account for 16.2% of the non-sovereign outstanding portfolio. And once again, the main focus was in China and in India. Now, very briefly, let me walk you through the development performance of ADB equity investment. So the evaluation looked at the overall success rate of ADB investment, which was 56%. And now, how does ADB look at overall success rates? It's derived from looking at 50 projects that had been validated at that time, during the time period by IED. And IED uses the ECG, the Evaluation Cooperations Group standard for assessing non-sovereign operations. I think in our previous sessions we talked about it, and there are really four main components. They look at development outcome or development results, at additionality, profitability, and work quality. Now, in terms of the actual results, ADB direct equity fare much, much better overall success rate than private equity funds. This is at 85% versus 37%. When it came to investment profitability, once again, direct equity fare much better than private equity funds, also significantly at 85 versus 27%. When it came to additionality, actually both were okay. At a overall 68%, equity for investment performed well when it came to additionality, which I'll discuss in a little bit what that we looked at. And then lastly, when it came to work quality, which is looking at screening, appraisal, and structuring ex ante, and then during the implementation of the project, looking at monitoring and supervision, it was found that only 48% of the equity investment performed well when it came to work quality. And once again, the direct equity investments fare much better than private equity funds. And then lastly, in terms of results, overall, direct equity, where development results was much more evident for direct equity than private equity funds. And it was found that direct equity actually generally improved issues of access to finance in the investment companies, expanded their operations, and strengthened their financial sustainability. This was not so evident in private equity funds. They performed well below expectations in those aspects. When it came to the role of enhancing job creation or improving environmental and social policies, or ESG standards, which is one of the things that is looked at as additionality, both direct equity and private equity funds, it was found, did play a role in enhancing both. And lastly, when it comes to corporate governance improvements, these were seen to be very limited, but were much more evident when it came to direct equity versus private equity funds. I just want to, as a last point is, actually this evaluation at the end made 5 very specific recommendations in 2019, and the management team accepted all the recommendations, even though a lot of the responses were saying that many of them were under implementation. But within a year of the recommendations being made, all the 5 recommendations were have been either fully implemented or largely implemented. So in a way, this evaluation was actually quite influential and was, I would say, well received by management in terms of the importance of it. And actually, ADB Ventures was just telling me that they are actually using this evaluation as part of showing how ADB actually does well when it comes to direct equity. Thank you.
Thank you very much, Gloria. So we heard three presentations, 2 of investment through equity, investment in private sector through equity in these 2 forms, right? Via funds and direct equity, and 1 special type of investment in venture capital for young companies and to promote innovation. Let's dig deeper on what you have put on the table before I turn to all of you for your questions and comments. If I heard well, the 3 of you are saying that your institutions were additional and that there was a good rationale to intervene in the market, private sector market, through equity. Did I hear well? And In a nutshell, can you confirm or deny what I just said, and why? Why in EIB was it rational, and why you believe that the institution added value?
Thanks, Marvin. So yes, I touched upon the rationale already in the presentation. We are there in this market to support innovation and to help small firms to create value and drive productivity, to enable their innovative products to be financed and to put into the market. So that's the main reason, and also the associated financing gap with financing of such firms. And I think the additionality, a good way to approach additionality is to look a little bit behind this financing gap and look a little bit at the market failures that drive this gap. And one of the most important explanation behind the financing gap is information asymmetries. It's a very, I mean, these firms are having a lot of risk in their business. They have a new product, they are burning cash on a daily basis. Most of them will never turn cash flow positive, and there will be a few that will probably become positive, and even fewer who will become unicorns, and then the investors in those unicorns will be rewarded with huge rewards. But it's a very uneven distribution of the results. So, and also, for investor, it's a very difficult situation to assess the possibilities, the business model of such a firm. So these information asymmetries between the investor and the entrepreneur are large. So you need experts, you need a lot of transparency, you need standards to be able to bridge this gap between the investor who has a natural caution against such a risky investment, and that's where MDBs can jump in. So with expertise on the market, MDBs can improve on governance, standardize the governance structures, information structures, reporting. Also, a large investor like the European Investment Fund can bring teams together, connect people who have compatible and knowledge, and create synergies within investing teams. Also, by being present as an investor, MDBs can put a quality stamp on investment funds. So somehow lend credibility through their expertise and investment to the private investors, and also can enable knowledge transfers between markets, between regions. So a model that works in, let's say, in Western Europe could be transmitted to in terms of governments, in terms of legislation, but also in terms of teams to other countries where the market is less developed. And another important aspect of the market failure is coming from the diversification. As I said, this distribution of the returns is very uneven. So you need a lot of different investments to actually achieve diversification and to achieve more homogeneous returns. And fund sizes are really matter from this respect. So with smaller fund size, investors are unable to achieve the necessary amount of diversification to get rid of diversifiable risk. So that's where also public sector investors like MDBs can come into the picture to allow the funds to grow to a certain size where diversification can actually happen. I'll probably stop here.
Thank you very much. So we heard some important ideas of why to intervene in this market, bridging information asymmetries, promoting diversification, knowledge transfer. What was the experience in EBRD? Alpert, your judgment, if I heard well,
Yes,
was that it was positive additionality.
I mean, there is here, I think Aaron covered the ground in a very comprehensive way. So maybe it is, what I can add is maybe on more specific about venture capital. One thing is its lack of skills. Essentially, in the regions that we operate, there were very few VC funds, if any. There were a couple of regional VC funds investing in multiple countries. And then they didn't have the expertise to properly assess the risk of those companies. Indeed, that skills were available, but in Western markets. So essentially, that was the market failure for the entrepreneurs. And then if the program, EBRD aimed to demonstrate like the profitability, commercial success, so that it can attract more Western capital into the region so that they can apply their own project selection skills and investment skills where we operate. So in that sense, it is, I mean, it's market failure and additionality combined in one sense. And then the other bit is also skills in terms of supporting the VC ecosystem, how to make business in those regions, and then demonstrating regional familiarity. So EBRD, mainly operating in post-Soviet economies and Eastern Europe, having EBRD on the ground itself and then having that regional familiarity, it gave another level of comfort to potential investors who would like to invest in that region, but would not invest if EBRD is not involved. So that was the main element of non-financial additionality as we assess in the evaluation.
Thank you very much. Thank you. Gloria?
Yes,
What's
okay.
your perspective from ADB?
Yes, so I think both Ara and Alper have pretty much touched upon about the market failure, whether addressing financing gaps, et cetera, and providing long-term capital. Maybe for the ADB in terms of evaluation for additionality, right? We look at both financial and non-financial additionality. What the evaluation tried to look at was on financial additionality, could the project have been financed adequately without ADB's participation? So looking sort of at the counterfactual, right? Would the project have gone ahead? That's one area. Another area that we looked at was, or IED looked at, was where did ADB help catalyze funds from other sources? And thirdly, on financial additionality, it's whether ADB's involvement was necessary to reduce, let's say, risk perceptions of other financiers. And then when it comes to non-financial additionality, areas that they looked at were issues such as did ADB help improve project design, client capacity, and of course, as everyone talks about, ESG, environmental, social, and governance standards. So very much similar to the experience of our colleagues at EIB and EBRD. Thank you.
Thank you very much. Let me again reiterate the importance of understanding how these interventions work in the private sector, because let's be clear, development happens through the private sector in market economies and including in China. The huge leap in China was because of a greater intervention of the private sector. And so understanding how these operations, this intervention work is fundamental for evaluators. We tend to get enthusiastic about public sector interventions, and the majority of the time we are talking about public sector interventions. But private sector interventions are fundamental. In a market economy, without effective private sector interventions and effective private sector markets operating appropriately, there's no development possible, right? So intervening in this space is fundamental for multilaterals and for public sector as well. I mean, the support that the China government has given to the private sector is what precisely has enabled this huge transformation in China over the last 40, 50 years. So that's why it is important to talk more about evaluation and private sector interventions. Now, we said that that profitability is an important test. And we spoke about these two ways of intervening through equity, indirectly through funds, or directly putting money, being an owner of the company itself. But what we heard here was different stories about profitability of these ways of intervening. We heard that for EBRD and for EIB, both ways of operating are profitable. But for ADB, intervening indirectly through funds was not profitable, or far less, or less effective. What explains this in your views?
Should I start?
Shortly, we've been warned already about timing, yes?
Okay, thanks, Marvin. I mean, I mentioned that these operations have been profitable for the EIB. However, just to go a little bit into more granular, it hasn't been a smooth ride all along. We started to invest, or the EIF started to invest into to venture capital and private equity in the late 90s, just before the dot-com bubble burst. I don't know if there is anyone still in the room who remembers the dot-com bubble. So it was when the dot-com bubble bursted in 2001. It was a huge collapse in the stock exchanges, and especially in the more risky part of the stock market investments. And our portfolio suffered a huge loss during this event. And given that equity investments take a very long time to become fruitful, it takes a lot of time to recover from such a loss. And it really takes sometimes decades for the returns to materialize. And I think it's very important for a lesson for MDBs who usually provide loans. You provide a loan, the debtor, the borrower, they start to pay interest rates. So immediately the next year or the year after, you see results coming in. Whereas for an equity investment, especially if you invest into a fund, it takes 5 years for an investment fund to build up a portfolio, and then another 5 years until this portfolio starts to see some exits and some final returns. So the time horizon on which the profitability materializes matters a lot. And also there is a lot of ups and downs during this process. So we, as MDBs, we have to prepare for this this very long-term view, and also the very large amount of volatility that happens over time. And just to wrap up, it's also interesting and important to highlight that these returns are very, very heterogeneous, not only for firms but also funds. The EIF has a large portfolio, and it's a handful of funds, or not a handful, but a small amount of funds that are driving the positive returns in the portfolio, even at fund level. So that's also an interesting lesson.
Gloria, let's hear from Gloria, who is in the other extreme, because I heard a different story from your side, right? That, as I said, returns were not the same for both ways of intervening.
Correct. So the evaluation looked at direct equity funds. Direct equity investments did much better than performed overall much better than private equity funds, and there's really a couple of reasons for that. So at that time, for direct equity, ADB was really doing most direct equity investments in the energy and in financial institutions, which were the two areas where ADB was able to find the right investment opportunities at the right time. On the other hand, when it came to private equity funds, it was found the reason why they mostly underperformed was because they were focused in less developed markets and in sectors where ADB did not have the expertise. Another big reason for the underperformance was a selection of poor fund managers at that time. And then another reason was having inconsistent investment approaches, as well as there were also some externalities to that as well during that time, factors such as economic crisis that affected the performance of private equity funds. Thank you.
How about EBRD in this special form of investment of venture capital?
Marvin, if you allow me, I would like to briefly speak about the 2018 equity evaluation. that EBRD did, because it has indeed data directly relates to this
Yeah,
AD, if that's okay.
We go quickly, right?
Very,
So that
very,
we
very
can
quick.
quickly,
Indeed,
quickly.
So we had
You have
this-
30 seconds more.
All right, okay. So I will be super brief. So and we had another evaluation which we completed and published in 2018, which compares direct equity and indirect equity performance of EBRD investments, and then it shows the exact opposite of what Gloria is now saying. In EBRD, indirect investments outperform direct investments meaningfully, and then Bob Finlayson, a former ADB evaluator at that time, he was EBRD evaluator. He did that, and then his main conclusion from that was that in this in indirect fund investments, the fund managers, they have a time horizon, as Aaron explained. So it is for their limited partners. They say that in X years of time, I am basically closing this fund. But for the direct equity investments, we don't have such time limit. This is why the investment officers at EBRD didn't want to realize the assets that they are depreciating in time, just to basically keeping them on the books and then hoping that it will recover was like a better strategy. And then this is why Bob claimed that direct equity is underperforming.
Very interesting. Very interesting. We're building up this story around investing through funds, but let's now talk about the heart of all of this. The heart of intervening, I see all of this additionality, rational, profitability, those are necessary conditions, but not sufficient. The fundamental condition for a good intervention is that it generates the results, development results, changes that are expected, like in any other intervention. So let's talk about what actually happened with this 27 billion of investment by European Investment Fund, and how much was it, the other component of the bank, a significant investment. What happened with venture capital and what happened actually on the ground with these investments in ADB? Aaron first.
Yeah, so as evaluators, we try to quantify somehow the impact. We were in a very lucky situation because already our colleagues at the EIF has done quite extensive work on quantitative impact assessment. So we had something to build on. However, and these impact assessments showed that EIF's investments into these funds at the final beneficiary level, at the level of the firms, generated extra employment and also extra innovation capacity in terms of patents and other indicators that were used. However, these results were, although very positive, the baseline, the counterfactual group, were firms who never received venture capital. So when we started this evaluation, we started to think whether this is the right counterfactual that we look for, and we started to ask, what if we compare the EIF performance to fully private venture capital beneficiaries? So there we can really identify the EIF input, and when we started this, we said that actually this is a test whether public money can be used at least the same efficiency as private money in this market. And finally, our result was that we didn't see much difference between the impact in terms of innovation, in terms of employment, in terms of growth, between the EIF investees and those firms that received fully private venture capital funding. And we interpreted this as a positive result, that actually the money that the European taxpayers invested into this project were used efficiently.
Was it positive or not too different from those who did not receive?
For those who did not receive any venture capital, the performance was better. Compared to fully private venture capital investees, the EIF investees were performing as well as them. So they were having
very similar result to
results,
private
yeah,
sector
yeah.
investment.
In terms of innovation performance, number of patents issued, employment growth, and other indicators.
Alfred, what was the experience of EBRD?
Yeah, it is. Unfortunately, our analysis is not as comprehensive as EIB's, but what we did was what is called as anti-portfolio analysis. So essentially, what we did was we looked at the performance of the companies that we basically, for which we completed the whole investment process but did not invest. So essentially, the companies, there are 30 companies where we did all the screening or the project selection. They come to the latest stage, but for some whatever reason, EBRD decided not to invest. So that's the 30 companies. And then there are these 15 companies that we did invest. So we collected data for these 30 companies, and we call them as anti-portfolio. And then we compared their performance with our portfolio in terms of job creation. And then there, what we see is that, again, very similar to EIB, there is a very strong impact on job creation. And it is like, I think it was around, if I'm not mistaken, per company, 350 additional jobs. And then we also looked at fundraising. On top of the total EBRD funding, are these companies in our portfolio, are they able to outperform anti-portfolio? Are they able to attract additional funds from third parties? Indeed, this is the bit that attracting additional, and yes, they are able to do like an additional 6 million euros for those companies. They managed to attract that capital. But it is, and that's in contrast with EIB, for innovation, I mean, we looked at a whole range of indicators to capture any impact on innovation, but nothing was there. It is, most of the basically innovative work was done after product development, mainly focusing on, again, marketing, sales, commercialization. It really did not, in terms of like being innovative, the impact was limited.
And precisely part of the purpose of that fund was to promote innovation.
Yeah, one of the main objectives, definitely.
Right. Gloria, the experience, what happened on the ground?
Yes, so not to repeat myself, so I had a slide that actually showed the development results from the evaluation, right? And you did see that direct equity funds, direct equity investments fare much better in terms of access to finance, in terms of investees seeing growth in the invested company, in terms of both of improving the quality of jobs or improving productivity gains. Maybe I'll just add one additional thing that the evaluation also looked at, which was looked at the catalytic and demonstration effects of these interventions, and it did show that direct investments were much more catalytic and had more demonstration effects, as well as produce more linkages in markets, some linkages in market and sector development, which were not seen so much with private equity funds. So.
Thank you very much, Gloria. Let me stop here and come to you, open the floor for comments, questions, curiosity for those who are not familiar with private sector evaluation. This is your moment to question these colleagues here about the work that they have presented. Questions, comments? Yes, Veronique.
Thank you very much. I would have a lot of questions and comments, but let me come back to this notion of innovation and also the notion of impact. Because we have different pictures, but at the same time, you still, and we talked about it this morning in our session, innovation is really what is one of the triggers for MDBs to start investing in equity and to support the private sector. Yet we find that it's still not really hitting the target. There is still a lot of things to do. We may also take a step back and wonder whether we have, as evaluators, the right tools to measure innovation. And that was something that we discussed internally when doing this evaluation. Of course, we need to use proxies, but how do you measure innovation? And how do you also ensure that, as evaluators, we take on board also the notion of risk? So for example, what you were saying, Aaron, about your results, You can take it in different ways. Because you say that actually there is no, it was about the apart, you know, with direct equity and indirect, or private investment and non-private. Either you could say, well, that's a good result, or you could say just the opposite, it's not a good result. Why is it a good result? Because it's not less profitable than direct private funds. But is it actually sufficient? Because it's exactly why MDBs enter in the game, is to be able to be more additional, because it's too risky for the private sector. So could we say that actually it was, because it's equal, it's unsuccessful? So what is your perception of that? And then on impact, of course, is that the final impact is improving inclusiveness, improving environmental effect, supporting the energy transition. We have all of these goals that MDBs have to fulfill, and for which private sector is really essential, and that's why also we are supporting private sector. Are we well equipped as evaluators also to measure that?
Mm-hmm. Any more comments or questions at this point? I want to come back also to this point that Veronique has made on environmental and social. Environmental and social assessment in private sector interventions is fundamental because the market does not by itself take care of this dimension. And so measuring that is critical in private sector evaluation. A project can deliver more jobs, growth, etc., but a total disaster environmentally and is on this basis declared unsuccessful. That's how it works. That's how I declare many projects unsuccessful because of this reason in other organizations. And so the question here to our colleagues is, if in your assessment, did you look at this dimension of the possible potential negative environmental and social effects of the intervention that your institutions supported? Aaron? Mm-hmm.
Okay, so when it comes to the questions from Veronique, thank you very much. They are both questions are very interesting. And first, when to measure innovation, it's a difficult task, and it's also I think when it comes to the economics profession, we are not putting enough effort into to refining the ways to do that. One of the standard metrics is number of patents, for example, and that's an obvious indicator. On the other hand, the importance of patents in innovation differs quite significantly from sector to sector. In healthcare, it's probably a very good indicator. In ICT, where we develop codes and software, patents doesn't have that much of an importance. So there is a lot of reasons to question the patent-based approach to innovation. What we found quite useful for this analysis, and it's also I think a good lesson, is that these firms actually are quite easy to reach in terms of, for example, through surveys. We can assume that they are, because they are innovative firms, we can assume that they would respond to emails, they would use computers, they would possibly a questionnaire sent in English wouldn't be a problem. So we try to make use of that luxury that we don't have in many other cases when we do innovations. And we asked survey questions focusing on innovation. For example, to what extent you have products that are targeting a European level, the global level, to what extent you have been spent, what percent of your expenses have been spent on innovation, and so on. So we, through the survey questionnaire, we managed to get a relatively good grasp of the innovation capacity of these firms. And again, the result what we found, to come back to my presentation, was that especially at the early stage firms, the innovation content and the innovation results were very strong. And as we went through the maturity spectrum of the firms, at the later stage, buyout stage transactions in the parlance of private equity, this innovation content was much smaller. Coming back to your second question on the whether achieving the same results as the private sector is good enough. We got this question many times from our board, from our management, from the EIF board. I think it's I think it is. It's a positive result. I mean, what we want to achieve here is scaling up an existing market to add more volumes. But I don't think that we should have the ambition to overperform the private investors. I think the best that we can ambition is that we as public servants do as well as they do. I don't think that it's a realistic expectation for MDBs to go beyond that. I think it would be unfair to ask our colleagues to be better than those professionals who bet their own money, own expertise, and their own existence to this purpose from a well-cushioned office in Luxembourg or London or wherever. So I think the results, on the other hand, that we managed to do as well as the private sector are already very important result. It means that public money is invested quite well, actually.
Well,
that's my interpretation.
It could be, if the results are as good as private sector for something they don't do, right? Because if it is for something they do, what is your role? Precisely here, the point was about additionality and not substituting the market, not substituting private sector agents. That's what it actually explains the use of public sector money to finance private sector projects. But let me briefly, because I wanted that we leave at least one thought in the very limited time that we have, one thought for those who are interested in evaluating private sector operation, one thought about a lesson, one recommendation to have in mind when assessing this type of products. If any of you want to intervene in this or in the previous questions, or perhaps given time limitation, we can leave this one thought, right, of in assessing private sector intervention, what is important, and particularly if you are evaluating this instrument, equity, that you have, the three of you have presented. What is important?
Should I?
Go ahead, please.
Yeah, it's one thing is for equity and venture capital. It is, I mean, there are out there a bunch of commercial data sets available. These are like comprehensive data sources. One is like PitchBook, for instance. I use Dealroom for my own evaluation. I know like EIB used Orbis. These are very rich data sets, and then those rich data sets gives us a very good understanding of how the market looks like, and then where we operate and how it is changes. And like in other type of like, in loan type of like instruments, we do not have that type of like in-depth data sets. The other bit of equity investments is that for the direct ones, we have typically board representation. We have lots of like the detailed information about the companies. And I think all that combined, these informations, I think it gives us a very rich source of information that that increases the overall quality of the evaluations and their credibility. That's I would say.
Gloria?
I'm not sure I can add much more. Maybe I can just talk about maybe one of the limitations rather than, recommendations from this type of evaluations is getting access to company data or information, right? Given the confidentiality of financial information or information from the private companies. So I think that's one area this evaluation was actually made fully confidential, and it's actually only the executive summary. It's available externally if you're wondering. Another thing is the evaluation also looked at. We always try to compare ourselves, right, to other institutions, and often, particularly No Name said that certain institutions are very much reserved in how much information can be shared. So comparisons cannot, sometimes may not be fully all there. So maybe that's what I can add. Thank you.
Very true. Many of these private sector evaluation, again, as I was saying this morning, listening to China was unique. Listening to private sector evaluation here is also unique because many of these evaluations are not in the public domain because we use private sector information. And so this opportunity of talking among evaluators and policymakers about private sector evaluation is also a unique opportunity to learn, for all of us to learn. Aaron.
Just to add, our evaluation report is fully public and and it can be downloaded from the EIB website. So if someone wants to read that, it's available.
Well, you see, there are different practices. But, at IFC, so that you're aware of this too, the evaluations are not even given to the board members, right? Because they have private sector proprietary information that the institution would run into legal risk if this information goes public. That's the reason why this information is not made public. If it is about profitability of the institution itself, there's no issue. But about private sector projects themselves, you cannot publish. Well, I think, colleagues, we have covered the ground. Anyway, we have come to the end of our time. Brian has told us. We have emphasized that to evaluate private sector interventions, you have to pay attention to additionality. You have to pay attention to the rationale of using public sector money, tax money, as Aaron said, to finance private sector operation. There has to be an economic and social rationale. You have to pay attention to the profitability of these operations. Is at the heart of this type of interventions because you don't and should not intervene in this market at a lower price than financial institutions, crowding out other agents. Then you're not adding any value, or you're doing it unfairly and unfair terms. And you have to pay attention, finally, to the actual results themselves. What happened on the ground, what actually changed as a result of this intervention. That's the logics of evaluating private sector operations, and we heard it here applied to a very specific instrument, equity, in its direct form and indirect form through funds, as well as using venture capital. We thank you for joining us this afternoon, and let's give the presenters a very warm round of applause. Thank you very much. Thank you very much.
Thank you, Marvin.
Thank you very much.
Thank you. Pleasure. Yeah.
Thank you very much.